Hi, everybody. Happy Valentine's Day. This is Tom Hayes with Hedge Fund Tips on February 14th. We're recording our 17th podcast VideoCast for the week ending today, Friday, on Valentine's Day. We're recording it a bit early so everyone can go celebrate. And first thing I'd like to do is to thank Jennifer Ablin, who is the U.S. markets editor for the Financial Times, for quoting me in her article on Monday about traders chasing the latest, micro cap, small cap vaccine cure for coronavirus. And basically the net of what I said, and you should read it at the Financial Times website. There's a link right here. You can click on Featured On. You'll see the Financial Times article, and then click here to see Jennifer's article. And the basic argument I made was that, all these pop and drop $1 and $2 and $5 stocks that are thinking that they have the next vaccine for coronavirus or the next cure, it's where retail money goes to die, basically. And, some may get lucky, but by and large, the way that we've played it since late January is to be in those stocks that may have positive upside exposure from coronavirus, but are fine businesses trading at reasonable valuations for the long term, irrespective of whether they're first to the finish line with a coronavirus cure and or vaccine. And the exposure we have, we've held over some of our Regeneron exposure from last year, which had a huge move in the fourth quarter. And we initiated in the end of January some AbbVie and some long-dated Gilead. That will potentially benefit. Gilead and AbbVie have antivirals that have anecdotally shown that they can cure coronavirus, although they're formally testing it on large-scale numbers to see if that's going to play out over a larger sample. But even if that's the case, that may be a short-term needle mover, but really you have to like the businesses for what they are. And as far as playing with penny stocks that claim that they have a vaccine, some will get lucky, but that's not a safe game to play unless you really have a specialized edge. So that was kind of the basis of the article, of these stocks that have just popped and dropped on rumors that it was the next cure for coronavirus. So beware in that area. Great article by Jennifer, and thank you once again for having me. Second, I would like to thank Shauna Smith of Yahoo Finance for having me on Wednesday, and Gret Suarez, the producer. That was a lot of fun. Definitely check in on that. I went through coronavirus. I went through extensive earnings outlook, market outlook, and you can find that also under Featured On the website, and check that out. So the first thing we're going to cover, also for next week, next Wednesday, the 19th of February at the 3 p.m. hour, I will be on Yahoo Finance. You can view it if you're a Verizon Fios customer. You can watch it on TV. If you are, or you can just go to the Yahoo Finance website. It streams live there all the time, or on Roku or Apple TV. At 3 p.m., I'll be on Jen Rogers and Miles Udland's show. Thank you, Olivia Balsamo, for putting me on that. So again, that's Wednesday the 19th at 3 p.m. And Thursday the 20th at 3 p.m., I'll be on the Clayman Countdown on Fox Business. And that, I do know my hit time is usually right after the hour, around 3:05. Thank you to Liz Clayman and Ellie Terrett, the producer, floor producer, for having me on Thursday the 20th. So tune in if you're free. Moving on, we're going to start this week with something very interesting. There was a Goldman Sachs note out this week about the single stock options notional volumes as a percentage of shares notional has risen to all-time high levels. And this was a very, very interesting note, and there may be more to say about that over the weekend, but we're going to go into it briefly because I just thought this was timely based on what I was saying on Yahoo on Wednesday, that the forward multiple now is over 19 times forward. We've come up 42 some odd percent off the December lows on the S&P, 19% since the August lows, 27% on the NASDAQ since the August lows. And so in order to keep going, which we'll cover on this podcast VideoCast, we're going to need more earnings, and we don't have them yet. I'm going to talk about where they might come from in the back half. But why is the single stock option notional volume as a percentage of shares notional risen to all-time high levels? And what's happening right now is a severe case of FOMO. The F stands for F I missed out, or fear of missing out. Let's go with the latter and be conservative on this call in case there are, well, if you're under 18, you shouldn't be listening to this anyway. This is not investment advice. This is simply my opinion. See the terms on the website. Nonetheless, FOMO's seriously going out on among active managers because many underperformed their benchmarks in 2019, trading too conservatively on trade fears. And now the rally just keeps continuing. Everyone thought January was going to turn the calendar and everyone was going to dump their stocks for tax reasons, but it just keeps climbing. And they're scrambling. What this is indicative of is that these active managers that have underperformed are now scrambling to get exposure after 19% move off the August lows in the S&P, 27% in the NASDAQ. And it's one thing to miss 1 year, but if you miss 2 years, it's a career death knell. So this is very, very common behavior off of steep drawdowns like we had in December of 2018, nearly a 20% correction we had from the Fed mismanagement during that period and cutting too aggressively. So what happens in these type of scenarios where you have those abrupt 20% correction is managers become shell-shocked. And the recency bias keeps them perpetually scared as the market's climbing. They continue to wait for the next shoe to drop, which is exactly when it doesn't, okay? Instead, what the market does is it continues to climb the wall of worry. We've been talking about it for weeks in our notes. You can click on sentiment under categories in our website. You'll see every note for the last year until everyone, so the market climbs this wall of worry until everyone is finally and reluctantly drawn back into the boat, back into the market, at which time the market can do what it always does, which is open the trap door and let everyone out at the wrong time after everyone's gotten in. Why this was so important, and this chart from Goldman Sachs really stood out for me right here, is the last time. So the source here, Goldman Sachs Global Investment Research, Option Metrics, as of February 10th. So this stood out because it was 2012. And this was immediately following the Euro crisis, summer of 2011, where we had the 20% correction from August to October 2011. And as the market recovered, managers were too conservative waiting for the next shoe to drop. And it never came, like we just talked about. The market just kept trending up. It trended up, actually, S&P 32% off its lows from 2011, the bottom in 2011, to spring of 2012, until all the managers who missed the recovery were behind their benchmarks and panicked back into the market with leverage. That's the key point to this metric. With leverage, they had to chase. They missed it. And they did that through call options to try to make up for lost ground at the exact wrong time, okay? So by the time call option volume hit historic levels, remember, it rallied from the 20% correction in summer of 11 all the way to spring 12, and it just kept going and going and going. By the time they got that exposure, the market was teed up for a correction to digest the gains. And sure enough, the market had a normal correction, 10.9% from April of 2012 to June of 2012, before recovering and, making new highs towards the back half of the year, but it rendered most of that new call premium absolutely worthless. So while, I think here, while we may have a little bit of room left to run now because so many people were caught off sides overreacting to coronavirus, and now the market's ripped and they were all short. So not only did you have the initial shorts as the first initial buyers on the rally, but now everyone has to chase back up. As you'll see in our note, the National Association of Active Investment Managers equity exposure dropped down to 62%. So they're screwed and they'll have to chase a little bit more. So I think maybe, another week or so, maybe we could get a few more points here. But based on the amount of call option volume and people chasing the top here, we have been, as I've put in my notes, and you'll see, you can check on the website, we've been trimming back the names that have had monster runs off the August lows and reallocating into areas that haven't yet run, and just lightening up and also building some cash as well. So we want to participate, but we also want to be defensive here because, what's the old saying? Bulls make money, bears make money, pigs get slaughtered. So we don't want to be a pig after a monster gain. And, so, basically, while there might be a little more gas in the tank here, the risk-reward ratio is not favorable to be initiating new exposure in the short term, following a 43% rally off the S&P off the December 18 lows. Better time will be coming to reload in coming months when much of this new option premium has decayed or gone worthless. So this Goldman thing is very, very timely. My interpretation is a bit different, but it really traces back to a similar situation. So enjoy what's left of this, but I don't think it's the time to get a ton of exposure to the stocks that have already had monster runs. Definitely time to rotate into some laggard sectors in our view. Time to build some cash. We have some selective shorts. We'll probably get a little more aggressive on that front in coming weeks if we move higher. But this says it all, and we are due for a little pullback. Nothing, catastrophic or crazy, because in the back half I see good things happening, and we'll talk about that now. Okay, so here we are. This week's key article was Chris Jansen, Good Vibes Stock Market and Sentiment Results, and I love this song just to get us in the mood. If you don't know who Chris Jansen is. Okay, for you non-country fans, sorry I let that go a little bit too long, but, I might have gone through the whole thing, so just be happy. I remember there was a pause button there. Love that song, and that's kind of the sentiment that we've been in with the market here. No one wants to hear any bad news, be quiet, everything's great, and that's been the play. But I think now when you start to look at estimates coming in a little bit, multiples expanding a little bit, and where's the justification going to come from? The Fed starting to kind of like waffle on how much liquidity they're going to continue to provide. I think they'll stay in the game, but maybe not as aggressive as the last 5 months. It's just a good time in the next month or so to start to see maybe a breather. So this recaps that, and our market commentary note, the comprehensive one, was a little bit earlier this week, and we're going to just talk about some of the factors that are constructive for us being bullish intermediate term for the end of the year. For the whole year, we're bullish. In the short term, I think we probably have a breather coming up after a week or two here once they flush out all the people who were wrong-footed on coronavirus in the short term. So earnings, actually, this was written on Tuesday. Earnings came down another little bit today on Friday. So it's down to 176.25, which was down from 176.47 last week. So, now we're at 9% earnings growth for 2020. The multiple's high. And the average for the last 5 years is 16.7 times multiple. So the other argument is, well, people say, well, relative to the 10-year, where else are you going to go? The dividend yield on the S&P is higher than dividend yield on the 10-year. The earnings yield is whatever it is, 5.8% relative to that. And those are all valid. And that's why we've run 42% off the bottom in 2018 for sure. But we need more earnings. The bottom line is having a 19 times forward multiple. Look, if it's late cycle, some people believe this is very, very late innings, then the multiple could go as high as 2021, and then you get a bigger correction. If you're mid-ish late cycle, you're going to need earnings to support this because the multiple is a bit high. So the earnings can come from three places. Number one, in December, before the Phase 1 deal was announced, the week before Duke did their survey, CEO, CFO sentiment was at its lowest level since March 2009 and late 2002, both of which were major bottoms in the market, not major tops. So that was a week before the deal was signed. The deal got signed, everyone got bullish, and then coronavirus came. So guidance should start to improve as more and more data comes out that coronavirus is contained. That's the good news. The bad news is Boeing's taken 50 bips off GDP, basically the 50 bips that we would have gained from the China deal. But now China is in a rough shape. Certainly for Q1 is going to look is going to have some weakness, and that's why I said in coming weeks in my Yahoo appearance, I said in coming weeks, probably you'll start to see a few companies saying, oh, Q1's a little soft because of coronavirus. We had to shut down this. We had to shut down that. Even if it gets contained, the backward-looking data will be weakish. So we won't get that really confident guidance until this corona thing is, really pared down. And at a 19 times multiple, you really need strong guidance. So guidance is probably not going to come for another month and a half, 2 months, the type of guidance we need to grow earnings. So let's take that off the table for right now. Second is the US dollar. We're not seeing any weakness in the dollar because everyone's has to buy the dollar to buy treasuries, the safe haven asset. So that's getting bid up because of coronavirus. As coronavirus subsides, money will come out of the dollar, come out of treasuries. And that year on year, even if we get a few percentage points, will be material for S&P earnings. But now it's pushed back a quarter. Again, helps the back half, doesn't help the front half. And third, most important thing of the whole story is Boeing. Boeing is the make or break for the year. Boeing estimates have come down $16 in the last 60 days, which speaks to two things. Number one, it's had an enormous impact on S&P earnings. But during that 60 days, S&P earnings have, in the aggregate, haven't fallen that much, despite Boeing taking give or take 10% off the top line of earnings. The market's held up, which means in aggregate, earnings have been better than expected. Guidance is going up for the 499 other components, while Boeing is collapsing. So basically what happens is, so the FAA a couple weeks ago said things were going better than expected on Boeing, and the stock rallied, I don't know, $15, $20, whatever it was. That's good news. But until that plane gets approved and it gets off the ground, we don't bring that earnings power back onto the S&P 500. It's expected to come in the summer. So given, let's hope early third quarter. But if the FAA comments meant anything, maybe it comes late to mid second quarter, which would be unbelievable. Because if you add that back, which you will pretty instantaneously because it's a duopoly situation and they don't have to knock on doors for customers, those orders will come right back in once the FAA signs off on it. $16 to S&P earnings would take earnings over 190, would take the multiple. Forward earnings over 190 would take the multiple down from 19 back down to 17, which is in line with the 5-year average. And with the 10-year trading so low, it's actually, the market would be really, really cheap. So if Boeing turns around, everything turns around overnight and the market can rally. I think that's more of a early third and certainly fourth quarter. That's how we are bullish for 2020. I think this air pocket, couple weeks out maybe when guidance starts to come in a little soft for Q1 is where we get a normal digestion of a 42% rally. and that's kind of how we're looking at things, and we'll change our mind as the facts change. Second thing I covered was the Federal Reserve. Most important thing here from the Fed meeting this week was and in the last couple of weeks was the talk about the labor force participation rate. And why that's important is because basically pre-crisis, it was over 67% labor force participation rate, dropped down to 62.5% by 2015. Worst recovery in history, and also certainly worst recession on history since the Great Depression. So they kind of go hand in hand, but it's been rising ever since, from 62.5 to this most recent employment report a week and a half ago showed 63.4%. And Larry Kudlow went on Bloomberg that day and said we could potentially add another 6 million people to the labor force. So, 3.6% unemployment rate, lowest in 50 years, is certainly something to celebrate. But boy, if we get that labor force participation rate even up to 65 and put another 3, 4, 5, 6 million people back to work, you want to see GDP growth, and you want to see the economy hum, and you want to see prosperity, it will be unbelievable. How it's going to happen, the only way it can happen is the Fed has to keep the pedal to the metal. And what I mean by that is that they basically raised rates 9 times from late 2015 to late 2018 in an effort to slow the economy, and they had to work day and night, but they finally did it. And they basically, for those of you who lived through it, in December of 18, it was called the Christmas Eve Massacre. The market basically crashed 20% in a short period of time. The other thing that they did in their earnest attempt to crush the economy was they drained $785 billion of liquidity in quantitative tightening over that 2-year period altogether. So just like there was a lagged effect to crush growth, and when I say crush growth, it's evidenced in 3 consecutive quarters of negative earnings growth. Q1, Q2, Q3, 2019 were negative earnings growth year on year because of the Fed's actions over 2 years straight. They finally did an about face in summer of 2019, realized the errors of their ways, and they cut 3 times, and they've added over $415 or $420 billion of liquidity in the last, call it 4.5 months. So the good news is they changed course, and we're seeing the effects. The bad news is we have to wait for the lagged effects. So just like we had to wait 2 years for the economy to slow after all the tightening, we'll have to wait 6 to 9 months or so to see the effects of the enhanced liquidity and the rate cuts in the economy. And again, that starts to bode well for, later Q2, early Q3 kind of time period versus today. That's number one. Number two, if they want to move the needle on the labor force participation rate, they've only unwound less than half of what they did over those 2 years. So we've only done 3 cuts out of 9 raises. So that's, a third. And then the quantitative tightening, which I think is more important. I know the market's pricing in more cuts. I don't think you're going to get more cuts, but I do think if they want to increase the labor force participation rate, they're going to continue to expand liquidity, and they'll probably make a mistake in the short term and try to tighten it too quickly because that's what they like to do. But my sense is they'll be more reluctant to cut and more likely to increase liquidity. And they've got a whole nother, $385 billion to unwind of liquidity that they can continue to increase liquidity. They could keep rates where it is, and that would start to really move the needle. And I believe Chair Powell is sincerely earnest in wanting to help these people that have not benefited from the recovery, that are called discouraged workers, that are no longer counted in the workforce in the calculations, and help them come back into the workforce, be productive, feel the sense of accomplishment. And I believe that's his mission, and I believe that's a really good thing. But he has to know that the only way to do that is to let the economy run hot. We have no real signs of inflation. So in order to get these people back in, you got to have capital competing for labor. And the way they do that is a little bit of wage inflation, and that also attracts the people off the sidelines who are maybe, discouraged and don't want to take a chance. So it's a good thing all around. So I think the liquidity will continue, probably more aggressively as the year goes on. It's kind of leveled off a little bit here recently, which is another reason I think we're going to digest some of the gains after the next week or two, start to digest some of it. But we'll see, and we'll change as the facts change. So that was the basis of the argument. As far as the short term, sentiment shot up to 41% on the bullish side, which is, higher end of the spectrum. It can go higher in the long term. We've shown that in recent weeks. So here it is. And we probably do get a little bit higher before we plateau a bit. Fear and greed was the same week on week. And here's what I was talking about, the active investment managers exposure. They're screwed here. With the market rallying out of this coronavirus correction, it's way up and they're way down. Again, flat-footed and offsides. And that's why you're seeing all this panic into options to try to catch up. And that usually leads to the market digesting and letting that premium expire worthless and decay massively. So that's the story for the core article of this week. Next thing is we do sector earnings. This is the earnings of the industrials in the last 60 days. Another reason that I'm saying maybe a week or two, but I don't think we have much more. I think the market wants to certainly get over 30,000 on the Dow. It seems like it wants to get to 10,000 plus on the NASDAQ, maybe 3,450, 3,500. I don't think 3,500 right away, but in that range on the S&P before cooling. But industrials were way down, but estimates for 2020, they're down 7.02% in the last 60 days. But again, if you exclude Boeing, they're only down 1.85%, but they are down. Boeing is going to be critical for that back half. So if we digest the gains in Q2, liquidity stays up, and then Boeing comes back, we could have a nice end to the year. And that's what keeps us intermediate term, bullish, short term, a little bit more, and then probably a little more cautious. So that's on industrials. And finally was this week, S&P estimates came down from 176.47 to 176.25. So they're creeping down a little bit. The multiple's creeping up. Again, another reason for the theme of this week's podcast and videocast. I'd like to thank you for tuning in this week. Happy Valentine's Day. Please tune in on Wednesday, 3 p.m. on Yahoo, and Thursday, 3 p.m. on Fox Business if you're around. Otherwise, we'll see you back here next week. Same time, same place. Make it a great one.